Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, June 30th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to give you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. I've got a lot to go over today, about I think 10 or so symbols, maybe right around there, of trades that I've done yesterday and today. And we also had some economic data come out today. We had the French consumer spending come out at negative 0.7. It was expected to be a negative 0.1, so a little worse than expected. But German retail sales came in higher than expected at 0.9% versus the expected 0.7%. We also got final GDP in Great Britain was right in line with expectations, and CPI flash estimate for Europe was slightly higher than expected at 0.1%, was expected even, and core CPI, consumer price index flash estimates was 0.9% versus the expected 0.8%, so slightly better than expected there. We also got here in the United States, Chicago PMI, which is Purchasing Managers Index, came in a lot higher than expected at 56.8, was expected 50.6, so better than expected there. We also have Fed Governor Bullard speaking today. The overall markets, as you can see here right now, crude oil /CL down $1.24 on the day, trading around $48.66. We're seeing a bit of separation between crude oil and the overall equities, although the equities rally has kind of come off a little bit. As you can see here on the Nasdaq, up almost 21 points on the day. It came down and tested the point of control and then bounced away from that. It's creating kind of a hangman doji there, so I'm a little bit nervous about any more upside for the next couple of days. Could see a bit of a pullback after the euphoria we've seen off of that Brexit. We sold off really hard. Now we're kind of retracing that. It could be a little bit overdone, a little too fast, a little too quick, not a lot of volume going on in there. Same thing we're seeing in the E-mini S&P, up 10 points on the day, right there at the point of control, which is where the most time and volume has been spent. And well, we're going to have to see what happens the next couple of days, whether or not we can sustain these rallies. Here's the breakdown of the E-mini S&P on the daily chart, 15-minute bars, and well above the value area high here, even for the last few days. So if we see this come down and settle down below that for an intraday type trade, that would be the time to look to short the E-mini S&Ps if you're trading that on a daily time frame. Scalping it, if you will. Under the trades that I've done, IBM, these are trades that I covered, and I covered most of these yesterday, so today you could probably get this IBM off a little bit better than where I took it off. But I had on the August 120 puts, and I originally sold those puts for $1. Bought them back yesterday for 44 cents, so slightly better than the 50% of my max profit target that I usually look for. Today it's probably quite a bit better. Walmart, another one that I had on with a call calendar, and I had on the August-July 72.5 call calendar, and I originally paid 59 cents for that strategy, sold it out for 93 cents. Today it looks like that it's above those 72.5 calls. I haven't looked at the pricing on that today, but it might be a little bit worse. On to Las Vegas Sands. I covered this trade also August, 39 puts. Originally sold them for $1.27. Remember, I just sold these just a few days ago when volatility was high, and I was looking for that volatility crush. So I sold those for $1.27, bought it back for 50% of my max profit, 63 cents on that. Looks like that was a good timing one there. SBUX, I had on a long call just to take advantage of hopefully some volatility expansion, which we didn't really see. SBUX really didn't participate a whole lot in that downside draft, but in SBUX, I had on the July 52.5 calls. Actually, I bought the 52.5 calls in July and sold the 57.5 calls to create that long call spread. And I paid a debit of $2.60 originally, got out for $3.87, and I can't imagine it's changed a whole lot from where I got out yesterday on that one. CMA, remember I kind of Comerica, which is ticker symbol CMA. I legged out of this strangle because remember on that sell-off I was like, those calls on the strangle could do nothing but hurt me, and I covered those for like 3 cents. They were the 48 calls, and I covered those for 48 cents because I originally had on the July 39.48 strangle. Now yesterday I talked about I thought I had on the 38.48 strangle. It was actually the 39.48 strangle, and I covered those 48 calls for 3 cents. And then yesterday I decided to cover the rest of my CMA position and covered those 39 puts for 89 cents. So if you add in the 89 cents I bought back those 39 puts for, and the 3 cents that I bought back the 48 puts, or 48 calls I should say, a few days ago, that made my total debit that I paid to get back out of that strangle 92 cents, where I originally sold it for $1.18. So it wasn't a huge winner there, but if you remember with that big sell-off when I was looking to cover those calls, I actually went in there rather than rolling those calls down and being mechanical that way. I felt that the big drop there wasn't going to help me if we got a bit of a pop back, and so I decided to go in and sell the July 34 puts, add a little bit more risk to that trade, and I collected 52 cents for that originally, bought them back yesterday for 13 cents. You can probably get out of that whole trade a bit better than where I did because it's continued to move a little bit higher. But again, I've been, with the snapback we've seen, I'm a little bit more nervous about the downside, more cautious I should say, and looking to take off some long deltas that I've been able to do pretty well on the upside, and now I'm looking to add short deltas with my overall portfolio. In Apache, I originally had on the July, Apache is ticker symbol APA, I had on the July 50 puts and originally sold them for 59 cents, bought them back for 23 cents, so slightly better than 50% of my max profit on that yesterday, but it just happened to have that theta and volatility contraction that worked out really well. Then on to the trades that I've done today. In Whole Foods, ticker symbol WFM, I decided to try and add some, actually I took this one off, and with WFM I had on the July 28 puts. I ended up covering those for 4 cents, and probably can get it a little bit better because maybe by a penny or so, because it's continued to rally as the day goes on. Then on to XRT. This is a trade that I added today. And in XRT, I sold the July 41, or actually, sorry, scratch that. On the July 41 puts I bought, and I originally paid 42 cents for the first tranche, and then went back into it because the market was rallying pretty good in there earlier on, and decided to add a little bit more risk to that trade and bought another tranche for 36 cents. The second tranche was a little bit less than the first tranche in price and in quantity, so my total average on those two trades is around 40 cents. So I did a little bit more the first time and then added a little bit to it the second time. And then on to Oracle. Oracle to me looks like it's getting a little bit overextended here to the upside. It has low implied volatility, but again, I'm looking for trades that I can add some short deltas because my portfolio is long. So I've been doing well on this rally, but like I said, I'm starting, the more it rallies, the more the contrarian in me comes out, and I'm looking to add short deltas. So Oracle kind of fit the bill because it's above this value area high. Usually I don't add this type of short delta unless it comes back down and settles within this value area, but it just to me seems like it's going to find a lot of resistance up here at this area now that it's kind of blasted through there. So I decided to go just above this high on this call spread. I don't really foresee it breaking above and making new highs, so I decided to go in there and do the August. Sold the 42 calls and bought the 43 calls to define my risk just in case it goes a little bit further than what I expected, and I collected 27 cents for that trade. So it's right there within the 25 to 30% the width of those strikes that I look for on that type of strategy, and you can check that out on a webinar. I've done several of those on being short call spreads and things of that nature, and what my rules are that goes into that. Also on Friday, tomorrow, we're going to be doing a strategy where we're doing synthetic short stock, for instance, and it's going to be the poor man's covered put is really what it's called, because instead of using short stock and trying to go out there and borrow that stock and getting short that underlying by borrowing stock, we're going to be building the strategy using options. So there's a little bit less risk involved in that. There's a higher return on capital by using this, and then we're also going to be selling a put on that strategy in order to lower our cost basis and increase our probability of profit, right? That's about all I got for you guys today. I know that was a quick and fast one, but went a little bit long in that regard, but I think I went through about 9 or 10 ticker symbols. All right, if you can't take that, take it easy.